So have you been thinking about investing in TSLY or any of the other YieldMax funds? Well, stick around because I'm going to talk about them a little bit. I read the prospectus and I have some insight to share of what I think about them if you're curious. Good morning. My name is Adam Kahn and I'm the Rational Investor. But I'm actually trying to think of a new name because what I've learned is when you search for me, it doesn't come up, but I'm not sure what to call me. So if any of you have any ideas of a new name to call, please feel free to chime in and feel free to make your jokes like the moron investor. I'm fine with it. Anyway, today is, well, I'm going to lie a little because I'm doing this video for tomorrow. Today is Monday, November 27th. It's actually the 26th when I'm recording it, but I have this stuff on my mind, so I wanted to talk about it today. Before I forget, if you haven't subscribed already, do me a favor and hit the subscribe button, smash the like button, make some comments. I really like the conversation. I'm also going to put a couple links in the description. If you deposit $10 or more into SoFi, which is what the links are for, you're going to get a free $25 gift. On top of that, they give myself and my son an account that I opened with my son, who turned 13 years old today, which I'm going to say is yesterday, but really today. So he gets really excited about that. I try to teach him about investing as well. We talk about real estate, we talk about stocks. I know he's a little bit young, so he doesn't always listen to me, but I try to instill that in him because I think it really helps for the future. Anyway, he gets really excited when those gifts come in. I appreciate the support. I want to thank you guys, and I'm thrilled to see how the channel's been growing. I mean, that's really exciting for me. Anyway, if you click on those links, you get that free money. It gives us a gift well, and I really appreciate that. So let's talk about TSLY, or if you've looked into Yieldmax funds, they've got all sorts of stuff, not just for Tesla. They do Amazon and Google and Microsoft and AMD, Nvidia, and many more. So I started reading this prospectus, and I don't know that everybody reads through exactly what they do. They use a synthetic option strategy to be long the stocks and then sell out of the money calls on a weekly basis. I also watched a video from a guy who either runs the fund or works on the fund or whatever else. And what I want to tell you is I don't know that everybody realizes the risk they're taking on for this type of return. So they basically buy an at the money call and sell an at the money put, which makes them synthetically long the stock. And I'll explain that real quick in case anybody doesn't understand. So a call option is a bet that the stock's going higher, and a put up, well, kind of, and if you're buying it. And a put option would make you long the stock if it went lower if you're selling it. So if stock X, and I'll just make one up, it's trading $100 a share, and I buy in $100 call, well, that makes me long the stock above $100, and if I sell the put, that makes me long the stock below $100. I collect that premium when I sell the put, and I pay the money when I buy the call. Now, the way that the fund makes money and is able to pay a dividend is they then sell a higher call, maybe a 101, 102, 103, whatever they see value in for the same week, they sell a call against it. So if they buy one $100 call, sell one $100 put, and sell a 103 call for a little bit of money as well, the the premium that they get for selling the 103 call, they can then send that out to their investors as what they call a dividend or whatever they're calling it. Well, they're long the stock by putting on the synthetic trade. By buying the call and selling the put, they're going to have the same move in the stock price, whatever that stock is, going up or down. And by selling the call that they sell, they limit their upside potential. So they're taking on all the risk of the stock movement. If the stock goes lower by selling the put, they're going to be long that underlying equity. The one I was looking at was Tesla. So they sell a Tesla put. If the stock goes lower, you're long Tesla. If the stock goes higher, the long call that you bought that's at the money makes you long the stock, but once it hits the price of the call that they sell, you've now sold that and you've made that little bit of profit. So you've limited your upside to whatever call they're selling against the synthetic long, and you still have the whole risk of the downside of the stock. I don't see it as a great way to get dividends, and I worry that people have a misconception of the type of risk they're having on because they're legitimately long these stocks. Now, if you want to be long these stocks, my advice now, you have to do your own research. If you're more comfortable with these ETFs and you want that dividend yield, by all means, you invest in whatever you want to invest in. Me personally, if I were going to do it, I would buy 200 shares of Tesla and I would sell a 1 month out call against it to get my own return on that investment and then trade around it from there. I don't really always trust fund managers and their ability to trade either. They're also limiting how much you can make. If you want to be long Tesla, be long Tesla. If it goes higher, you can sell some of the shares to take a profit. I also watched a guy who was getting 4-to-1 leverage to buy 4 times as many options, going on and on about how this is how he's growing his account. That's great as long as it works, or as my brother would say, until it doesn't work. Because what he's essentially doing, he gets a credit card for the account, he puts in some money, let's say it's $50,000, because it wasn't a small amount of money. He's buying 100,000 worth of the stock and kind of saying, I have no risk, because what are the odds Tesla goes out of business? Okay, I understand it's not very high probability that Tesla will go out of business, but I don't know what kind of risk the fund managers are taking and how much leverage they're using on their synthetic purchasing, as well as they've limited your upside. So if the stock dropped from 240 to 150, I really don't know how much Tesla is going to go down because you're long Tesla by owning that fund. Maybe it puts him, knocks him out of his position. I really don't know how much it goes. And then what he was continuing to say is since he gets 4-to-1 leverage, since he's only really using 2-to-1, he has a credit card attached to the account. So when he goes on vacation or whatever else, he just charges it on that credit card and the dividends pay that off. So he's building equity because the dividends are paying enough to pay off the credit card and pay off his margin debt for now. I'm not going to say that that changes or that that becomes an issue, but if it does, it's a real problem and could really wipe them out. So I'd hate to see others following that lead and not realizing the risk they're taking on. A dividend is not a guarantee. A dividend could be lowered, it could be cut completely, it has all sorts of things that can change. And in these funds in particular, it's really not guaranteed. My guess is they're going to change every month. They're using weekly options, which are the most volatile. So they're trading the most volatile options that exist on these equities. They haven't invented anything new. It's just a great sales pitch because people are looking for dividend return and they're using stocks that traditionally don't really have dividends. Well, they still don't really have dividends. They're just selling calls against a covered position. They're also selling the puts, so they have the full downside risk. Again, I really want people to understand that. You have the full downside risk of whatever underlying stock they're trading, whether that's Microsoft, Google, Amazon. They've picked the big ones on purpose, and I want to be long most of those stocks. So you have that full downside risk if the stock market goes lower, but you're limited how much you can make if the stock goes up because the calls that they sell that are out of the money, they'll get taken on the trade. I understand they give a dividend every month, so it feels warm and fuzzy and you feel like you're making money based on the dividend. However, it's a very risky strategy. If you are comfortable with that strategy and you believe in these fund managers and you want them managing those trades, great. That's why I say you need to do your own research and really understand it. But if you think they're just buying Tesla and managing to figure out some fancy way to pay a dividend off of it, it's not some new fancy way. They're actually limiting your upside gains and giving you a payout because you can't make the full percentage that the stock goes up. Anybody could sell a call against an underlying equity to get that return. Any stock you buy that has options that trade on it, to some degree, I encourage you to learn about the options. I even do that with some of my dividend stocks, but I'll do it much longer term. My thought is if I buy, I'm making this up and use an example, I don't have the numbers in front of me, but if I buy Devon Energy, which is a company I like, and it's trading around, I think it closed around $45 a share on Friday. Well, if I would be happy to sell it for 60, 65, $70 in a year, and I can get a dollar or 50 cents or whatever it is to sell a 1 year out option, well, I might as well pick up that extra money as long as I was thinking of selling that stock anyway and get additional yield. You can do the same thing with Tesla or AMD or Google. Thing for me is I'd want to be really careful about that. As I've said in other videos, I want to own those stocks forever. So if I'm buying Amazon, I don't know that I really want to sell the calls against it just because I get that return. If I do, I would do it on a really small percentage of my how many I own because I want to own Amazon forever at this point unless something changes where I see the company differently. To limit how much I can make if the stock has a great year just isn't something I'm interested in doing. So again, be really careful with these funds. Read through the prospectus if you want. See, you just have to pull it up and see if the information that I'm telling you is what you see as well. I just think people don't realize what they're really investing in. They see these high dividends. Oh, I'm getting 40% return. There's no risk in it. Well, there's good risk in those things. So be careful. Anyway, again, do me a favor, like, subscribe, thumbs up, chime in, tell me why I'm wrong and why you love these companies. Not telling you not to invest in them. I just hope you understand exactly what they are. Hope you had a great Thanksgiving, by the way.